Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Paul Lennick. How are you doing today, Paul?
Great, good to connect.
Good. Well, we brought Paul on the show because typically we bring on investing experts because that's what people want to hear. This week we have an expert in certain areas that are, in my opinion, going to be hot trends in the next 10 years. They are now, and they're going to continue to be because that's just the direction of the economy. So, Paul, maybe you can kind of tell us a little bit about your background.
Yeah, absolutely. I come from the consulting space, so what they call the Big Four consulting, PwC and Deloitte, largely helping clients transform their businesses and become more profitable, and ultimately focused on private equity clients for a number of years, serving them and their portfolio companies that continue to buy and sell businesses throughout the U.S. Glad to connect with you and happy to share my experience.
Yeah. So why'd you go down that path? Like what kind of brought you into that space?
Yeah, I think focusing on consulting has always been one since came out of undergraduate school to help solve problems in the corporate sense and to be able to align different client resources to make change. That's always a challenge. And oftentimes, external experts, consultants will come in to help align management to drive change or transformation in businesses. And I found that fascinating. And so I spent many, many years working with clients across a number of industries to that end. I found private equity, a client base, quite interesting because typically private equity investors, because they own the businesses that they're involved with, can have a direct influence on some of the pace of change introduced into those portfolio investments. And so representing those types of clients help accelerate change in some of the businesses often purchased because they're distressed assets and they need change.
Yeah. So what are some areas, let's kind of get into some trends, because we talked before the show about some of the areas that you really see as ways to improve profit, but there's so many trends going on in the economy, and I think COVID shifted a lot of it and it accelerated a lot of existing trends. So what, in your opinion, are some of the biggest trends that you're seeing?
Yeah, some of the biggest trends, I say, going back a couple of years, in the space, were really about helping companies grow. So that manifests in some of these predictive models, algorithms and data scientist funded activities to help companies get information to make better decisions, to kind of look around the corner, so to speak. And through that, concepts of big data, data analytics, mining information, commingling information into decision criteria to drive growth was really kind of the de facto area that a lot of businesses were focusing in on kind of pre-COVID. Once COVID came, there was kind of retrenching back to looking at the core business. Ultimately, some businesses were impacted much more directly than others, and certain thrive businesses, a lot of technology businesses thrive. But the general sense is businesses kind of took their eye off this growth model to more, hey, let's really focus on cost containment, creating efficiencies in our business. There's some headwinds with interest rates, with debt in the country, with inaccessibility of borrowing funds. Ultimately, so let's control our destiny and really focus less on this growth and some of these very sophisticated, interesting predictive modeling models, but really on cost and efficiency and scalability to improve profitability. And that's really where my current focus is now, helping clients drive efficiencies and profitability through cost containment and process improvement, particularly in the back office of companies.
So let's talk about the predictive models. What does that mean? Just so listeners can understand what that means.
Yeah, when you're trying to figure out, typically a company, where do you price your products? What markets do you sell your products in? What are your product extensions? Do you expand geographies, of your business? Do you retrench your business? In order to do that, you have to, rely more on intuition, less on intuition and more on data, right? So an entrepreneur relies on intuition to start their business, where they put their products and their pricing. But ultimately, over time, as a business grows, you need real data and information to harness that to help drive decisions in an informed way. And so these predictive models really take historical data and extrapolate it forward. They try to commingle it with forecast data from third-party sources, ultimately trying to triangulate on making more informed decisions. And access to data and some of these AI tools and some predictive modeling algorithms are sophisticated enough to help streamline that prospect for smaller businesses or middle market businesses to get that kind of information. But ultimately, at the end of the day, it's trying to help and supplement management and make more informed decisions based on information rather than intuition.
Okay. Yeah, that makes sense. So, yeah, I would imagine at a certain level, you have to start using data, or even at a small level, it probably makes sense to use data. But I would imagine that there's a certain part of that where you get disconnected. So if I think at like a small business level, right? I run a small business. I think anything under, hundreds of people is probably a small business. Um, but if I think about it, like I'm in the weeds with my clients, I hear all the conversations. I know what's going on. Like I have my finger on the pulse of what's going on in the market. But I would imagine like there's a certain point where you kind of disconnect from that. So if you're just using data, you're not having these conversations. You're just relying on the data when the data can be deceiving. So how should people kind of address that as they kind of really kind of add that piece to their business?
I think you layer on more and more data and investment in data as the business scales, right? When you're 100 people or less, maybe, in the minds of the leaders, the business can be run and there's not a lot of customers or a lot of complexity to the business at that stage that you need to build sophisticated a database or a data model. But at some point, there's an inflection where not all that information can be contained in a person's head. And so, as well as that, say, lead entrepreneur has 99 employees working for them, getting data points and interacting with vendors and customers and regulators that ultimately needs to be coalesced, in some fashion. And this is outside of an accounting system. An accounting system just manages the debits and the credits and the P&L of a business. This is more decision-making data in terms of, as I said before, products, pricing, geographies, strategic partnerships, and things like that. And ultimately, that data can be put into a repository and fed, over time, so it's freshened up, and ultimately drive in as part of triangulation and decision making as that business scales up.
So what are some of the biggest providers out there that are really in this trend or focusing on predictive models and data?
Well, the consulting firms really typically will help, businesses try to figure out what to measure and what is important. So, that's the likes of McKinsey and Bain and BCG, and there's a lot of other boutique and tier 2 and tier 3 related firms, but it is generally the consultants that will come in and work with management to help figure out what it is you want to measure to begin with. And that ties to what is the strategy of that business. And then ultimately that needs to be codified in some sort of technology application in order to make it repeatable beyond the conceptual of what you want to measure. How do you actually measure? How do you collect data? And that's when the technology related advisors or the consultants might come and help build a system for you. If you're too small to hire external third parties, then obviously this can be done internally. It's nothing sophisticated outside of a company's ability to do it, but oftentimes a third party might have advantage around seeing other competitors in that space or seeing trends in other industries that are applicable to that particular client situation that it might be valuable to bring into the mix. So, it's the consulting firms out there that start the process and then try to manifest that through the technology firms and or internal resources. So, solutions around predictive modeling can be fed, over time. And I think this is a trend that was really pretty significant pre-COVID. I think now most of the conversation I'm having with clients in my firm are back to the basics. How do I reduce cost? How do I get more efficient? If my top line is soft or softening into 2023 and beyond, what do I do so I can make payroll, right? And that then turns to the equation of cost down. And that's really a lot of what's being discussed right now, in this current economic environment is sort of cost down methods.
So what are you seeing as trends that are causing that? I think, from a macro perspective, everyone's talking about where's this recession. I mean, we definitely see signs of it, but on the other hand, we also don't see signs of it. So, what are you seeing in the business world that is causing people to want to reduce costs at this point compared to other times?
Yeah, well, a lot of what I do is in the private equity space. So if you think about private equity, it's buying and selling businesses in the traditional buyout model of private equity. So private equity investors, they're looking for an undervalued asset. It could be a standalone business. It could be a division of a larger corporation that they want to carve out of that larger corporation and make a standalone business or a new co. Either way, private equity is looking for undervalued businesses or business units that they can buy and they can improve through the typical hold period, which is 3 to 5 years. So now what's happening is that accessibility to capital is somewhat constrained because interest rates are quite high and onerous. And so that's caused private equity powder, they call it, or capital on the sidelines to be more restricted in being deployed. And so if capital is restricted, then the volume of transactions in the M&A space or private equity space goes down. The hold times of the typical 3 to 5 year period are extended, and private equity investors are sitting there with businesses that they wanted to divest, but because of capital limits or the constraints around the market are unable to divest. So what do you do with that business? You've held a business for 3 years, 4 years, you wanted to sell it, can't. So you go back in to that business working with the management, as the owner, and you say, hey, CEO, hey, CFO, what can we do to increase profitability? And therefore, that leads to the discussion around, okay, we're not growing because, yes, we are having a recession in this particular industry, not all industries, but a lot of the industries are having recession or concerns around the future. And therefore, let's take cost out and work collaboratively with the owners, the private equity firm itself, to do that. So that's where I see things happening. Now, not all sectors are affected, but in aggregate, because of private equity kind of has this hold period process of redeploying capital over time, and capital is now more expensive and hold periods are extending, it's refocusing back on cost down in the private equity space.
So how do you think private equity is going to be affected in the, in this ensuing recession? Or, I mean, we haven't technically hit stagflation yet, although I think it's pretty much inevitable. What do you expect people are going to be doing, in the private equity space during that period? Because as you said, when you have cheap money, you can buy anything. I have a lot of friends in private equity, and they said things are so overvalued, but they have to keep buying because people are throwing money at them. But now that's kind of changed a little bit. So, how do you see your industry, reacting to those changes? I mean, you just told us some things, but there's probably more things that you have to do as well.
Yeah, I mean, I see private equity being much more constrained and thoughtful in the deployment of capital. There's going to be fewer opportunities to deploy capital, and portfolio companies are going to be coming on the market at standalone buyout kind of basis. And investors will be more cautious in deploying that capital, making sure they've done their diligence on that business very thoroughly, from commercial to operational diligence, just to make sure that that capital when deployed is secure, and they've really thought through that investment relative to the larger portfolio. So I think it's much more discipline going into the investment is likely going to be part of the overall equation. I think as well, there's going to be more, and we're seeing this right now actually, more carve-outs. So carve-outs are this process, and I alluded to it earlier, where General Electric, let's say, wants to sell off their aircraft engine business, just making this up, right? So they're carving out that engine business from the larger General Electric organization. Well, who's going to buy that business? Well, Rolls-Royce as a strategic might want to buy that business, but as well, financial investors, the Apollos, the KKR, these larger private equity firms may want to buy that large division and carve it out from General Electric. And that takes, 1 to 2 to 3 years to extract that division from General Electric, create a standalone business, rebrand that business, obviously recapitalize that business, and go forward. Those are hard kind of transactions to engage in. And not all private equity firms will want to take on that complexity, but move General Electric aside. There's lots of smaller businesses that are selling up their divisions or getting rid of a particular geography that they currently support. So I'm seeing more and more of that kind of carve out activity on the buy side be more prevalent in 2023 and 2024. It's really hard for a private equity firm to buy a standalone business that's really clean. There's a lot of competition for that. It's much more likely that a private equity firm has to be creative, go source opportunities, oftentimes to an unbeknownst seller. What I mean by that is a company that doesn't know they should sell a division, but private equity comes in the equation and says, hey, we want to buy that division. You currently weren't thinking of selling it. You haven't contacted investment bankers to sell it yet, but we're attracted to it because we've done our diligence. We'd like to approach you to buy that business. And so that's a creative carve out, I call it, where it's actually created by the minds of the private equity investor to approach an unbeknownst seller to extract that business unit, create a carve out scenario, and then basically improve that carved out business in a way that they could flip that in 3 to 5 years and make a bunch of money. So I think there's more creative carve outs, complex transactions, in that venue than the traditional simple buyout type of business in the private equity space. So I see that happening more and more in the future.
So do you see, so basically carve outs or spinoffs,
Spin-offs, divestitures, there could be platform carve-outs, there could be bolt-on carve-outs. There's lots of different lingo in it, but it's basically, yeah, spin out or divestiture.
Okay, so one thing I always found interesting is during certain periods in the markets, there are certain strategies are more attractive than others. I think with cheap money, it's been really easy to to go after and acquire businesses and merge because it's cheap. You can do it, and you can make money pretty much immediately with cheap money. However, as money gets expensive, I've noticed this in the past in history, like expensive money means there's a lot more spin-offs. Do you see that is the primary reason because of the cost of the money, or are there other factors that go into that as well from a kind of a trend perspective?
Yeah, I think cost of money in this economic environment is the number one, right? I think now we're sitting at cost of borrowing, it's double, if not triple in some instances, depending on credit rating for businesses. So that has a material impact on, what that investor is going to do, and how much capital they're going to go borrow, and what do their investors, if they're pulling from an investment fund, expect on return. So it creates all of those pressures into the equation. So I think that's number one. I think as well, there was over the last 15 years, a lot of new entrants into the private equity space. The traditional firms have been out there for 30 plus years. And if you look back over the last couple of decades, the returns from private equity investors have outstripped those from, investing in the S&P, or putting money into index funds or things like that. And so private equity has more risk, but if the returns are triple or quadruple, as an investor, what you could get putting your money in an S&P index fund, it's going to accrue money to private equity funds. And so therefore, a bunch of new funds and new private equity firms have really created a lot of space and grown quite a bit in the last 15 years. So yes, interest rates, money's more expensive. There's a lot more private equity firms, as well, that are in the space, particularly in the middle market, that are creating transactions and volume, in the equation as well. So, as much as private equity is sort of down a little bit in the early part of this year relative to previous years in transaction volume, it's a space that will continue to grow in good times and in bad. Maybe there's more distressed assets now than there have been in previous years, but that's, the private equity firms focus just on distressed assets. And those firms will start to show that they've got, the capabilities to buy those investments, to make the improvements in them, and then turn them around in 3 to 5 years and resell them. So a lot of different factors in there, but I agree with you that cost of money is probably the largest thing, top of mind right now, which is extending hold times. It's creating retrenching back to cost down, and it's really focusing on what we have the right management team. And do we have, quite honestly, too much cost in the organization, particularly in the tech sector right now? You see with a lot of layoffs and risks that are happening in organizations that are well known and published in the Wall Street Journal, from like Twitter to Microsoft, Amazon. Yeah, those are published, but there's tens of thousands of smaller Silicon Valley, Austin-based businesses that are taking cuts right now because that particular sector overhired during the COVID timeframe. So those types of factors as well are underway. And once some of that clearinghouse on the risks are done, I think then private equity investors will impose upon their portfolio companies to get back to growth and cost down and streamlining with some outsourcing, which is some of the things that we provide in the marketplace in terms of outsourcing services drive costs down.
Okay. So you mentioned that private equity has more risk. Can you talk about some of the risks of owning private equity just in general?
Yeah, you can make a bad investment. So there are rotten eggs that private equity puts, X millions of billions of dollars into that end up going bankrupt. So, there's the risk of making a bad investment, one, that doesn't turn out. Two, there's a risk of overpaying. Going back a couple, 3 years, or even a year and a half ago, there'd be a clean company on the market, a buyout. There'd be 10, 15 private equity firms bidding, on buying that business because the diligence looked good. It was a clean business. You could value it appropriately. And then the multiples went up, the multiples being the price that is paid for a business based on earnings multiple. Those went up 20 to 25 to 30 in some instances for SaaS-based businesses. So there was an overpaying, of that asset, as well, that contributed to some of the challenges, that we're seeing right now.
What about other things like the liquidity factor, or one of the ones that I've seen most is taking on too much debt, right? They buy businesses and then they raise a bunch of capital and pay themselves a big dividend, and what about that? I mean, I've seen there were some very public failures that have happened. So, what do you think about that?
Yeah, I mean, to me, that's part of like the default, and where you've not, you know, pro forma your worst case scenario. So you got the best, middle, and the worst case scenario as a private equity investor buying a business. You didn't put enough effort in that worst case scenario. You've got a revolver of credit against that business you're using to fund, operating expenses and capital expenses, and that revolver goes up from 4% interest to 14. Because it's an adjustable rate on a revolver through a loan, and so that then squeezes that business, considerably. So yes, I do think access to capital, the adjustable rates that a lot of these businesses are financed on, is creating a squeeze, and so we're going to continue to see more of that. But again, that does provide opportunity for private equity investors, particularly on the distressed side, or those that might have powder sitting on the side that's unconstrained. It's not debt based, but equity based investing capital. So you'll see a rise in some of those transactions going forward in 2023, 2024.
Okay. Yeah, that makes a lot of sense. So, can you talk about, just, I think as the listeners, private equity is just this kind of, this thing way out here that most people don't invest in. I mean, the institutional side, definitely it's heavily invested in private equity. And, when the retail public, it wasn't as accessible up until maybe the last, I don't know, 5 years or so. It became a lot more accessible. But maybe you can talk about a transaction that maybe didn't go so well. Not necessarily you, but just in general, we can use as kind of like an example of what to look for. And so, yeah, I don't know if you have an example off the top of your head.
Yeah, I mean, we can't name specific companies here, but it is fairly often where private equity will raise capital from individuals, rich individuals, or institutional investors, as you mentioned before. I agree. It's not generally open an investment for the retail investor that wants to put $10,000 to play. That's not going to meet the the hurdle to invest in a private equity fund. But you can invest through mutual funds and things like that, sort of indirectly into private equity. But you're right; it's not necessarily accessible to everybody. The good thing about private equity, not to digress a little bit, is if you are working at a company that is purchased by a private equity firm, let's say it was a entrepreneur founder-led business, and it's grown to the point where it attracted private equity funding. The owners sold the business to private equity because they didn't have the capital to invest in geographic expansion, let's say expansion to Europe or expansion to Asia, or the company needed some significant R&D investment to revolutionize their products that had begun a little dormant and long in the tooth. So capital comes in, and as an employee now owned by a private equity firm, the compensation model oftentimes changes to the betterment of the employee. So I think most people in the American workforce would feel private equity more from being owned by a private equity firm and given the chance to have a much more variable or a performance-based compensation model. That can be beneficial and lucrative for folks that are owned by private equity. At the end of the day, private equity firms want to make that business grow, and they're willing to put more money on the top performers in those businesses on a variable basis to promote growth and to promote high achievement. So I think that is the way a lot of people in the workforce would experience private equity than being a direct investor, in private equity. But I'd say, where investments go wrong are where private equity firms overpay, for an asset because there are multiple, buying parties, much like overpaying for a house, and go to, monetize that investment over time and realize that they didn't do significant diligence, on the business, to the point where they looked at the risk of the business in a way that created a model for understanding what could be the worst case scenario, and that plays out. And so they ultimately have to then divest that business 2 to 3 years at a loss and write that loss off against the investment of other investments. But again, private equity is not a single all eggs in one basket approach. They try to have multiple investments to diversify that risk. And so if they have one bad investment that they overpaid and couldn't monetize that investment over time and have to sell it at a loss, it's kind of covered by the gains of other investments in that basket.
Okay, so I want to get back to the core focus of what you guys do and kind of additive value and saving on cost. I think as we're going into recession, as most people would agree, even though we haven't hit it and people are wondering why, we talk about that a lot on the show. However, One of the things that obviously is going to be important during a recession is saving on costs. So can you talk a little bit about some of the things that are being done now with cost savings for companies, like what people are doing, what companies are doing, and of course you've got things like AI in there too, which is a relatively new trend. So maybe you can kind of talk about like what is being applied now to companies so that, we can look at, say, hey, maybe there's opportunities in these areas.
Yeah, and I think in terms of cost, I'll comment specifically around back office cost. So there's lots of cost to business. There's COGS, which may be cost that goes into the product or the solution. I'm speaking mostly about G&A costs, costs of employees that are doing HR, finance, accounting, information technology, the folks at the corporate level typically that are supporting the business. And it's a cost center. And so a lot of what we do is work with that cost center, that G&A cost center, and determine if there's ways to improve the performance and reduce that cost, but not in impact negatively the performance of the business. The last thing you want to do is make cuts in your back office and screw with your customer intimacy or screw with your ability to deliver solutions into the marketplace. So making cost cuts that don't impact the business is the secret sauce here. And so oftentimes we'll work with management and say, okay, how much are you spending on IT technology? How much are you spending on your systems and your reporting? And is there a better way to do that? Is there a more streamlined system to either implement or, in often cases, reduce the complexity of systems by removing systems from that application environment to lower the cost that way? So we'll look at technology investment and see if there's a way to streamline that. Then we'll look at the people. Who are the people doing the IT, the finance, the accounting? And oftentimes, some of those activities can be outsourced, to a third party. Again, non-core to the business, not directly touching customers, but in the back office. So, instead of having, expensive US-based resources that have benefits and fringe, that becomes kind of a fixed cost, we can move a lot of that workload through my firm offshore or onshore, nearshore, yet lower costs, and they call it labor arbitrage, right? Doing the same thing at a lower labor cost. That becomes another place to save money. And now the latest thing is to go from there to employing a technology, even again, in the form of robotic process automation, or they call it RPA being one of the fastest growing areas of software in the world right now. Maybe now starting to be outmatched by AI, although starting from a smaller base. But robotic process automation really is using software bots that emulate how humans interact with systems. And then replace that human interaction with a software bot. And they have these assisted bots or unassisted bots, depending on the complexity of the process that's being bodified. But that is the next tier. Once you take processes and move them, say, offshore, save on labor, then you move towards robotic process automation and AI-driven technology to bring that cost even further down. And that's the stage that we're in right now. If companies have not made that first tier to outsource, that's a great opportunity to save money. If they have, then there's another opportunity to move towards further automation using software and the technologies that are at play right now. And some of these are not just brand new, like RPA has been on 10 years. So we're on third generation, fourth generation robotic process automation. It isn't risky like it once was. And you can easily, through a use case or a pilot, prove the ROI before you make the investment in robotic process automation. And oftentimes we'll work with our clients to put a bot in, see if it's efficient enough to justify further investment, and the answer will be no, it's not. It will say that's not a good ROI investment of RPA. In other cases, it is, and they'll continue to grow with more and more bots being deployed across that business.
So one question, obviously, that I'm sure listeners are thinking right now is the obvious AI, which is relatively new to people and what their understanding of the world is. And I think probably a lot of people don't understand the implications of AI, but you had mentioned there's a lot of AI tools out already. Where do you see that being used now, and where do you see that going? Because it just seems like we're at the very beginning of a very long road with AI.
Yeah, and very beginning. Obviously, Sam Altman testifying to Congress today. I mean, there's a lot of interest and understanding from our legislators what AI can be in the future, and to the extent it's needs to be regulated, obviously, a top of mind discussion point. Where I look at AI specifically and narrowly is in the back office, right? For me, allowing intelligent software to learn a process on its own and doesn't have to be told by a coder or a developer what to do in certain if-then statements, streamlines the deployment of technology in a way that can bring value much more quickly. So I see AI, in essence, sort of replacing that software developer that has to go in and tweak that process automation to allow the payables, the receivables, the IT processing and things like that to happen. That human labor that's doing that coding goes away. And AI could sit in that middle and do that much more efficiently in an intelligent learning way. Again, shortens the timeline to get these processes streamlined, and of course increases further disintermediation of labor. I think that's what people are concerned about. Like, is my job going to go away? To an extent, yes, I think that's going to happen, but it also may make you more efficient at your job. That 30% of that job that is kind of mundane or routine can be automated, freeing up 30% of your time to focus on customer intimacy and things that AI can't do and never probably will able to do. But so it increases opportunities, I guess is my point, for people, as well as some threats of taking off some of those routine things. But I see AI as the next iteration of intelligently and intuitively automating processes and taking the coding labor out of that equation and that process that takes time.
So before we wrap it up, I want to ask, how long do you think it'll be before AI is able to be integrated in the ways that you've said? I mean, it pretty much came out with ChatGPT. I know it wasn't created then, but it pretty much came out with ChatGPT in like November, and it's 6 months later, and it's already well integrated in a lot of things. Still got a lot of work to do, but where do you see that being for a timeline before it really starts to be applied in the ways you're talking about?
Well, look, I don't necessarily agree the genesis or the impetus of AI started with ChatGPT. I mean, the AI has been discussed and out there for 40 years. I think the manifestation of some of these learning, consumer connected AI opportunities became more prolific with ChatGPT, where you can go put it on your phone, you can start asking questions. So all of a sudden people think AI was born last year. It's been out for quite some time. And just the next evolution of intelligent learning predictive solutions. So, again, don't argue about the genesis point, but the genesis point that you point to is when a lot of people started to become aware of it, right? Be able to touch it in a way that made it more real than just a conceptual where people normally thought it was robots, things like that. It's really software. And so I think it's going to be the next 10, 15 years where we're going to see so many new business models cropping up. I think back to the dot-com day. There was 90% of businesses that started .com failed. They couldn't get the business model, they couldn't get the funding. I think the same thing here with AI. There's gonna be a lot of business models that are gonna be experimented with. Some are gonna be home runs, the Ubers of the world and whatever it is. But we don't know yet. We're just on the cusp of the genesis of that. That's why I really focus on where I can control and understand what AI is in that back office, making companies more profitable, less reliant on labor, less reliant on human thinking, and utilize technology to do some of that routine thinking and predictive modeling and learning of systems and processes, and then automating that. That's where I see we're already doing it today. That's happening today. That isn't like in a year from now. We're doing that AI deployments right now, utilizing Google tools and other Microsoft tools that exist today. But it's in the boring back office, not in the consumer having interaction with their monitor and their AI right now or their avatar right now. That's yet to come.
Yeah. Okay. So Paul, as we kind of wrap it up here, what are some final thoughts you can leave our listeners with, and where can people find more about you?
Yeah, I'm on LinkedIn. Happy to connect with anybody, small business, large business, medium business. The conversation around how technology and how outsourcing can drive profitability, in your business is something that I'm passionate about, and have 600 people in my firm ready to deliver those solutions. And we've been delivering those solutions for the last 20 years. So we're here not only to educate and inform, but as well to grow our business selfishly through this process. So any reach outs would be fantastic through LinkedIn.
Great. Well, thanks, Paul. I appreciate you coming to the show and sharing your wisdom with us.
Great, Kirk. Good to see you. Thank you for the time.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Paul. Really appreciate him coming on the show and sharing his wisdom with us. Now we're in the panel portion of the show where we have our very own Megan Gorman. Hey, Megan.
Hey, Kirk, how you doing?
Good. Doing great in this wonderful summer we have here. And we also have our very own Barb Friedberg. Hey, Barb.
Good morning, everyone. Happy to be here.
Great. Well, glad to have you as well. So, Megan, let's start with you. What were some of your takeaways from the interview?
Yeah, I mean, I think it's a really interesting topic to be talking about right now because over the last 25 years, private markets have become larger and larger. And so there is a greater opportunity set to invest in the private markets. So what I liked about this interview is he hit on a lot of things that are really key if you want to consider adding private markets to your portfolio. And I just want to say it's not a fit for everybody. It is a more complex due diligence process to enter the private markets. But if done the right way, you as an investor can get tremendous reward.
Nice.
So it was interesting to hear all of that. And I know we're going to delve into this in a moment after you hear Barb's initial thoughts.
Okay. Yeah, Barb, off to you. What are some of your thoughts?
One thing I think is a big topic we've got to look at as Lennick talked about trends, and that is AI. I can't tell you how many AI emails I get in my inbox every day. Use AI to pick your stocks. And so in my research, what I found is there's a lot of different sides to using AI in investing. And I'd like to delve a little into pros, cons. Is it for you? Which platform you might want to take? And do you need it?
Okay, great. Well, we'll definitely talk about AI today. It's the topic du jour. It may not be the topic of this episode, but it's going to come up pretty much in every conversation for the next 10 years. So Megan, you talked about private markets, and let's just talk about that for a minute, because you work with a lot of high net worth people, and the private markets are, I assume, a bigger part of your practice. So, what are private markets, and what does that mean to you and your clients?
Yeah, I mean, private markets, to put quite simply, are investments made in assets that are not in publicly traded exchanges, right? And they tend to be things like private credit, venture capital, private equity, infrastructure, and real estate. So those are sort of the 5 areas we typically see investing. And, private equity is a fascinating space. But unlike the publicly traded markets, where if you want to buy a stock, you could go pull the stock up, you could listen to earnings, you could read analyst reports, the private markets are a little more opaque, right? And so as a result, what happens is in order to access them, it's all about due diligence and process. So if you've ever seen a presentation for an investment in a diversified private equity fund, one of the things that really will stick out to you is that in a 60, 70 page deck, 50 pages are really focused on due diligence. How do they take the entire investment universe and winnow it down to the core investments that they're going to deploy funds in? So what I would tell anyone who's looking to start to make an allocation to private markets is, one, you're going to have to take your time to figure out if it is the right thing in general for your portfolio. And then on an annual basis, you will have to make sure you're taking the time to do the due diligence to get the right allocation for that year's vintage. So some of the things that we typically see is you're looking for the depth and breadth of the team. What is their experience, right? How do they, what are their backgrounds? How long have they worked together in terms of tenure? You're also looking at relationships. So the crazy thing about private equity and the private markets world is it's fascinating. We only ever hear the great stories, but really the best opportunity set is it's a very, very limited group of firms that are providing consistent year over year high level returns. And so the question is, how do you get access to those funds? And a lot of times is when you're working with a firm that is an established firm, they have relationships that get you access. And that's some of the things to think about. And then in due diligence, what you want to understand is once they deploy funds into a company, what is the process around that? What are they looking for? Is this something like middle management buyout, which I know he hit on, where they might be looking to change out the management team, right? Is this something about cutting costs and then trying to sell it later, to flip it? So you want to understand what is the overall investment thesis. And what's really fascinating about the private markets, and this is the last thing I'll say, and then pass it to Barb, is thematically, things change in each vintage, right? So this year, we're seeing a lot of middle market, large market buyout. Thematically, as I'm looking at different funds, we're seeing that consistently. Now, what could be next in the marketplace is something much more in a focus on things like infrastructure, right? Or we brought up AI, or the fact that we've got all that new legislation in regards to infrastructure for the country and the environment. And you might start to see that thematically appear in future private equity vintages. So things will change and evolve, but what you really want to do is build structure and diligence around it and understand as you research it that the team you're investing in has process and diligence built into it. And when you pay those fees, that's what you're paying for.
Nice. So I like that, Megan. I appreciate the background there. Barb, what about you? So, should people do private equity? I mean, there's a lot of retail investors listening to this, and they're probably thinking, oh, wow, there's some great returns there. Should I do that too?
Great question. Let's go back to the ABCs of private equity. First of all, how do you access it? Who can access it? And should you access private equity? So first of all, the offers that Megan is talking about, Megan works with really rich people, okay? And they are beyond what we call an accredited investor. Just very quick, accredited investor is someone that meets some income and net worth guidelines, investable assets of $1 million, annual income of 200,000 if you're single, 300 if you're a couple. Additionally, if you don't hit those levels, there's also a new category of an accredited investor, and that's someone who can say they're knowledgeable. They work in the investment industry. Maybe they have a Series 7 or something like that. So that group of people is an accredited investor. They have access to a lot more deals than someone who is not at those levels now. Okay, how do you get access to these type of private equity deals? Well, if you're really rich, then you've got a lot more options. today, though, even those that are non-accredited have access to a lot of these crowdfunding platforms that have sprung up in the last couple of years, Yield Street, startup, different apps. And the question you want to ask yourself is, are these type of apps for me? Because they also offer access. Many of them offer access to private real estate investing. Some of them offer access to startup investing. And you think, hey, cool, for, you know, a certain amount of money, I can get into these type of formerly very, very difficult to access investments. So let me give my caveats. They are risky. They are much, 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 much riskier than the public markets. Every single disclosure says, be willing to lose 100% of your investment. So be aware of that. Yeah, you might get a juicy return, but you might not. That's number one. Number
Can
two,
I jump in real quick there?
yes, of course.
Because I do want to mention something with return. I think going in with crazy return expectations of private markets can be a little bit, you got to be careful. The reason the returns are high is the illiquidity premium, right? Wouldn't you make that argument?
That's one of the reasons.
Yeah.
Illiquidity means you have to tie your money up for a certain amount of time. It's not like you go to your brokerage, type in a ticker and sell your stock or bond fund. So yeah, that most of them are illiquid as well, but they're also risky because they're not vetted. Many of these are not regulated by the Securities and Exchange Commission. So the reason that they require you to be accredited or to read all these disclosures is because these investments don't go under the type of scrutiny that a publicly traded investment does. So we put that out there as an asset class, something to think about. But if you throw them in contrast with publicly traded investments, as well as now bonds and cash equivalent investments, where you can get 5, 6, 7, 8% returns on, you know, more secure corporate bond funds, you really want to think about, is it worth it to go into a riskier investment?
Yeah.
And tie your money up for longer.
Yeah, no, that's a great point, Barb. So, you know, it kind of brings up this question when it comes to due diligence, and I'll ask you, Megan. I was listening to a great podcast. I think it was with Michael Lewis, actually, where he's talking about SBF and like the process that went there and all the people that gave him money, even though he was a, you know, I know what people call him now. Back then they used a different term, but now they're calling him a bumbling idiot who used to play games and meetings. And I look at it back then, and back then they're like, oh, he's a genius. He can play games and meetings and hold a meeting. And I'm just like, kind of arrogant fool would do that. But the point was that he made, which I thought was really interesting, is that here's a guy who took hundreds of millions of dollars from investors, you know, to grow his company. And if you asked him a question or pushed back in any way, he would just like say, you're not included. Well, I'm not going to take your investment dollars. And so it raises the question of, you know, we get into this situation where you said there's a handful of firms that are really, you know, getting all the money because they're really the best, and the other ones are maybe not as consistent or good. Same happens in the hedge fund world, where, you know, all the top managers get all of the money and everyone else is just not even considered. You get this really this margin of difference in who's gathering all the assets. So it kind of brings the point of like, they have all the control. Can you really do due diligence on these firms? Because if you ever push back, they'll say, yeah, sorry, you're too much work. I'm going to go with somebody else. Like, how does that work in that market where there's so few firms that are attracting so much capital?
So let me just clarify the question. Are you talking about like the big firms that have the funds, like, or are you talking about like direct, you know, co-investing?
Either one. I mean, you mentioned that a handful of firms are really attracting all the capital. So I'm just wondering, like, they have the
I mean, and they're
control,
firms,
if you will.
yeah. So those firms, I mean, are firms that even if you went into off the street and you were the wealthiest guy in the world, you might not get access to, right? I mean, these are funds like Excel Partners, Anderson Horowitz, right? Bain Capital, top tier opportunity sets, right? How you get access to those is, variety of different firms, the Morgan Stanleys, the Merrill Lynch's, the Goldman Sachs's, all can give you access, iCapital. There's a number of different ways to access funds, vintages, they get access to those funds. But, anyone in the private market space is used to due diligence. So I'll give it to you both from the institutional standpoint and the co-investing standpoint. So in the institutional standpoint, every year a new vintage comes out. And usually we start hearing about it earlier. And there will be, sort of a moment where they open up the war room for you to read the documents, for you to meet with them, to understand the diligence, to understand what's going on with this year's vintage. And then they'll start to release more information like this fund is going to invest in 8 managers. 7 of the 8 managers are going to be private equity. 1 will be venture capital. 5 of the 8 managers will be US based. 1 will be in Asia and 2 will be in Europe. Like you'll start to get an understanding of what, and then also it'll tell you what segments of the market they're going to go after, right? So you start to get an understanding what that looks like. So when you're dealing with the big established firms, the diligence process is laid out for you and you interact with them through the process. If you have a different situation, so let's say someone comes to you and says, you should invest in this fund or you should invest in this company, diligence is expected. It's part of the process, right? So last week, I have a client who is looking to do a convertible note with a company, right? My team and I, we spend an hour and a half on the phone with the CEO and the general counsel. And then we've been going back and forth all week with legal on clarification of terms. So it's time consuming and it's expensive. I mean, any of my clients who do the private investing world where they are like looking to do a direct investment in a company, you have to consider the investment due diligence costs as well as the legal due diligence costs. So it's time consuming, it can be costly, but you have to, part of the reason people want to go in the private markets is if they're doing the established funds, they're looking for a consistent rate of return. And it sounds crazy, but a standard private equity fund is 10 years. The first 5 years, you're putting money to work. The back half of the fund, typically the last 5 years, you are harvesting and taking distributions. So it actually is an interesting vehicle because it starts to self-fund itself. The newer commitments you make, your prior vintages are going to fund them. It's also an interesting retirement vehicle for income for specific people. So, I mean, I think the thing is, it's a lot of work doing this stuff. And I think on the most of my clients in the private world who are private investing are doing the established funds that we do the vintage every year. The clients who are doing direct investing, a lot of times it's friends and family, right? They know someone, and it appeals to this thing in human nature. Everybody wants to be the guy on the ground floor, right? Plastics, right? Like all of that. And that is something in human nature. And so when you are deciding to do this, and I talk to a lot of my clients about it, is we might decide the asset allocation overall is 10% private markets, but that might take 5 to 7 years to get to 10%. And within that 10%, it might be the majority of it is established funds that we invest in on an annual basis. We always invest in the annual vintage, but then a sliver of it might be play money where they can go and, do a convertible note with this company or invest direct here because their friend is there. And they understand that the risk factor on that is so through the roof that it's likely to not work, right? But they just are hoping, fingers crossed, that they are the luckiest guy or gal on the street.
Yeah. No,
I hope that was helpful.
That's very helpful. Thank you. All right, so I want to get into AI here because that is one of the biggest trends that's going to take our eyeballs for the next 5-10 years. So Barb, what are your thoughts? I mean, AI is still new. Most people don't understand it. People are still confused by it. It reminds me of crypto like 5 years ago, where people are like, what the hell is this thing? So, but AI is, I think even the smartest people still don't fully understand it. Even the people created it, admittedly, say I'm still confused by some of the things that it's doing. So I wonder, like, what are your thoughts on AI and kind of where that's going to go in the next 5 to 10 years?
AI for investing in plain language means programming a computer to pick your investments for you. So a programmer puts in the inputs that they're looking for. Let's say they want high growth stocks, they have different parameters. Usually they put in hundreds of parameters with the goal of choosing winning stocks. Now, from all that I've read, most of these programs are designed not for long-term investors, but for traders. So they're looking for the stocks that are going to outperform others during the next 1 to 3 months. And many of the AI programs have been successful at picking stocks that are going to outperform in the short term. I have yet to see any AI literature about stocks that AI has picked for the long term. And so with that in mind, add on another layer. There are many, many, many companies that are professing to do that. Question for you, Mr. and Ms. Investor, is, do you want to try one of these AI programs? Do you want to trade with one? Do you want to see how they work? Because the results it's so new, we don't know. I would say if you're interested, if you want to, there's a ton of them out there. Just Google it, take a small percentage of your money and, see if it works or not. Are you going to get the system that's going to beat all the other investors? AI is really not completely new. It's been used in some form or other for quite a while. There's been algorithmic trading on a very large scale. So bottom line is, if you want to try it, why not? Pick one company or a couple of companies, listen to their recommendations. Some of them are free. Others have a monthly charge. See how they work, how their picks pan out, or even do it with paper trading where you don't even deploy any money yet, and make a decision, is it worth a try or not? My thoughts are, I'm not an active trader, so I'm not going to do it. I am also a very, very, very minor stock picker. In general, my assets are invested with index funds, which have low fees and frankly have given me the returns I need to create the wealth I need and the cash flow.
So let me ask you, Barb, because you were talking about kind of algorithmic trading in a way where you're programming computers and it spits out an outcome. How is that different from AI? Because people have been doing algorithmic trading for a while now.
It's not.
Okay.
It's one version of the same thing. And AI is like a huge super umbrella. It's like saying index fund investing. Well, it's not one thing. There's today scores of indexes that measure different niches of the stock market. So yeah, you can invest in an S&P 500, which follows the performance of the biggest 500 companies in the US, or you can invest in a small cap growth value ETF, smaller niche. Same way with algorithmic trading, with AI. It depends what factors they are following.
Okay. Yeah, it kind of makes me wonder. I think one of the challenges we have now is because AI is so new and people are basically putting a wrapper together and just putting the word AI on it and saying, oh, it's AI. And it's like, well, what are you talking about? Like, why is this any different from what you were doing before? I'm sure you both remember the .com era where everything was .com, or, I forget the other words that were used, like internet something or .com, or there was another like term or two, and this happened in the 70s and the 80s and the 90s. There's always some term that they threw on there to attract more money. So I find it humorous. When ChatGPT came out, there a few apps showed up where it was basically the app was a wrapper for ChatGPT. It was the same thing. They just put a different, and you had to pay for it at the time when ChatGPT was free. But Megan,
I want to interrupt here though, and give a ChatGPT example. I write for US News, Forbes, Investopedia, a lot of the big publications. I sometimes do a lot of list posts on best ETFs for this, best ETFs for that, best mutual funds, whatever. And so on one of the posts, what I did was I did my regular screening through one of the publicly available screening platforms, Fidelity, Morningstar, whatever, to get my initial list of candidates. And then I said, I'm going to test an AI bot. So I gave the parameters to ChatGPT to see if they'd come up with any other ETFs that I had missed on the other screener. And for my query, which I think was like best long-term bond funds, the response came back, well, we don't have any data after 2021, so we can't complete this request for you. So I thought, well, this is fascinating that this is the limitation of ChatGPT for fund screening. And what it points out is you better know what you're working with and what AI program you're using and what they promise and what their data set is.
Yeah, I totally agree. There's a lot more. There's a lot more to it when you kind of dig in the weeds. So Megan, what about you? What are your thoughts? I mean, you're probably seeing this show up in a lot of investing and a lot of clients saying, hey, I want to have access to this, and it's still really early. How do you kind of see this AI trend?
Well, on a first note, personally, I think AI is wildly dangerous. I do not understand why we are not regulating it, but again, we didn't regulate the crypto markets, and here we are. So, you know, I think it is interesting on twofold, right? So the first thing is, you know, when you are doing due diligence on private investing, one of the questions I think is going to become more common is how much does your firm use of AI in doing diligence, right? A lot of private investing relies on relationships. So I don't think AI is going to upend that, but I do think AI might start being used, and it is being used to sort of test the objective process that has to happen in terms of looking at a fund. I do think that we're seeing more and more investments where AI is being factored in. I do think there's something there, and it is something that people are excited about, right? AI, I think people know has a future, but the question is, where does the technology go? So you're seeing more and more clients interested in this. You know, and it's one area to add to. You know, it's funny because I think some of the best private investing is into some of the more boring stuff, right? Like I am really excited about some of the infrastructure funds coming out right now versus AI, just because I think some of the overall rates of return over time will be really substantial. Whereas AI, I think to some degree is, you know, everybody's just sort of throwing spaghetti against the wall to see if it sticks. But I do see it more and more in funds, and clients are excited about it.
Nice. All right. So let's, as we get close to wrapping it up here, final thoughts from you, Barb.
Whatever you want to invest in, do your research first. If you're looking at investments that are riskier, make sure you limit your exposure. So take a small portion of your portfolio and be willing to risk that part of your investing portfolio. So I am Barbara Friedberg. You can find me at Barbara Friedberg Personal Finance, LinkedIn, and across the web.
Great.
See you next time.
Thanks for coming on, Barb. Megan, final thoughts from you, and where can people find more about you?
I mean, not to sound like a Debbie Downer, the private markets are fascinating. I know I have clients invest in them, but they are probably not appropriate for most people. And it's for a couple of reasons. One is the illiquidity aspect of it. And the other is there's just a lot of crap out there. And so, getting access to the best opportunity sets takes a lot of time, and you have to be of a certain asset base size. And I'm not sure it will be worth it for most people. So that's just me giving candor there. I just don't think it's the right fit for everybody. But if it is the right fit for you, diligence, diligence, diligence. That's what's going to matter. I'm Megan Gorman. You can follow me on Instagram at All the President's Money, and my new book will be out in September of 2024. So I'm looking forward to launching that website shortly.
Awesome. Well, we can't wait to see that, Megan. And once it gets closer, you'll have to tell us a little bit more about your book and the launch.
I'm hopeful you'll have me on as a guest.
Maybe. We'll see. We'll see. You have to pass our high screening test, though, so I don't know.
I know.
Well, great. Well, thank you for both coming on the show. And I couldn't agree more, Megan. I think that, the private equity is kind of like hedge funds and the other shiny objects that are out there. People have a lot of FOMO of, I didn't get in this. Why am I not in this? Everybody else is in this. And, you need to kind of stick to your knitting sometimes and know that you can't be everything to everybody. So couldn't agree more with that. And I think, people should know what they're getting into and not just be in it because their buddy's doing it. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.